Despite the recent correction, crude oil prices still remain roughly 41% higher from pre-war levels. Brent crude, for instance, trades around $110 per barrel, relative to $78 per barrel in December 2021. As a result, prices of petrol and diesel have recorded a sharp climb in India, helping domestic refiners clock significant rise in their gross refining margins. This is evident from the Singapore benchmark GRM, which is a gauge of regional refining margins.
See, the Singapore benchmark refinery margin, which is a widely tracked benchmark in India, continues to be in excess of $20 per barrel. Historically, Singapore benchmark has typically on an average been around 6 or 7, mostly in most years. So in a way, the benchmark has almost tripled, especially in the aftermath of Russia-Ukraine crisis. So that is benefiting the oil marketing companies in India and also the refiners.
Experts predict these margins could remain on the higher end as the global supply deficit for refined products remains unmet.
As far as other Indian companies are concerned, which is refiners, things are turning out to be rather healthy for the refiners, although there are concerns on the marketing front. But as far as the refinery segment of oil marketing companies or any standalone refiner is concerned, they are a decent amount of returns because of very strong refinery margin environment. Also, India is able to source Russian crude at a discount to the market price, and which is also additionally adding the refinery margins. As far as standalone refiners are concerned, yes, they would be making a reasonable amount of refinery margin, because as I mentioned earlier, also refinery margin environment continues to be very strong, and that will be reflected in their numbers.
From the lot, analysts are especially bullish on Reliance Industries. According to Jefferies, RIL is a key beneficiary of energy inflation, with every $1 per barrel improvement in annualized refining margins adding an estimated $400 to $450 million to its consolidated EBITDA. On the other hand, the road ahead for integrated refiners remains bumpy. While shares of standalone refiners like MRPL and CPCL have soared up to 3 times so far this year, investors have exited counters of BPCL, IOC and HPCL. ICICI Securities, for instance, believes gains in refining margins are unlikely to make up for losses on the retail front. Estimated losses on petrol and diesel have risen to 10.5 rupees and 12.5 rupees per litre for Q1 FY23. We estimate that every $1 per barrel incremental GRM boost only compensates for 3 to 4 rupees a litre of retail fuel loss. That said, markets will seek direction from global peers today. Later in the week, investors will monitor the core sector output, manufacturing PMI and auto sales data.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
तुम इतना डर गए?
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.